Hello, everyone. Today on the final bar, we'll do our normal Monday routine. We'll hit the market from three directions: top-down macro, bottom-up stock picking, sector rotation. We hit on the key themes in each of those three important areas. The S&P, the Dow diverging just a bit, but overall, I would say follow through sort of strength. One of the big themes that we talked about is consumer, with consumer discretionary breaking out relative to consumer staples. Tells you investors are still on offense. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets using the power of technical analysis, the power of investor psychology and sentiment, the power of stock charts to try to make sense of things. I was told early on with some of my early mentors, if you have one thing to use to make sense of these markets, make it a daily chart of the S&P 500. All the other stuff are ways to validate and qualify and get into a lot more detail and certainly understand the mechanics a little better. But at the end of the day, don't forget to focus on the message embedded in price. And there's a lot of wisdom in that very simple analysis. Are buyers outweighing sellers, anecdotally speaking, or maybe better put, is buying power outweighing selling pressure? And when you see week like we've seen in the last week or two, where you've seen sort of a clear rotation, particularly on that tactical time frame from distribution to accumulation, it shows you there's buying power that's emerging, and it's overwhelming the people's need to take risk off. We're going to look at a lot of charts to put more details behind what I just said. Great guests this week, actually, three of the best. Tomorrow on the 19th, we have Katie Stockton from Fairlead Strategies in Connecticut. On Wednesday, Miss Schneider coming to us from Santa Fe. She's a co-founder of Market Gauge. Then on Thursday, the 21st, we have Craig Johnson, the technical analyst at Piper Sandler in Minneapolis. Then coming up next week on Tuesday, the 26th, Roman Bogomazov. He's the founder of Wyckoff Analytics in San Francisco. Also, as a reminder, my next free webcast as part of Market Misbehavior is coming up tomorrow on Tuesday, the 19th, running at 1 p.m. Eastern. I'm going to be doing a webcast called Buy in October, 5 Charts to Follow. Back in May, I did an event called Sell in May and some sort of tagline about how are these, the warning signs to look for. As you know, if you followed the markets over the last 6 months, the distribution didn't come till much later. And a lot of the things we talked about just really didn't materialize, but it gave you a checklist of things to follow. We're going to talk about the same thing because November and December actually tend to be seasonally pretty strong for stocks. We'll talk about some of the things that would convince me and that I think should convince you to get more on offense. So go to marketmisbehavior.com/October to sign up for that free event if you're interested. Let's continue on today's show. Again, we have a three-pronged approach every Monday. It's a lot of fun. It really mirrors sort of my process every week of making sense of the market. Goes macro to micro. So we'll start with the big picture. We'll look at the overall environment, some of the larger asset classes, things like stocks versus bonds, interest rates, commodities, currencies, and so forth, cryptocurrencies as well. Then we'll talk about sector rotation, and then we'll get into individual names and themes to pay attention to. The S&P 500 finishing about a third of a percent higher today. The Dow actually down a little bit. The New York Composite down just a tiny bit as well. But overall, certainly sort of a stronger look to the day. The NASDAQ, by the way, leading the way higher with the NASDAQ 100 up over 1%. The VIX actually bounced higher today, and that's a good reminder that a lot of people think about the VIX and the S&P as being inversely related, right? Stocks go higher on lower volatility, stocks go down on higher volatility. It is not a one-to-one relationship. Today, you have one of those days where the S&P and the VIX actually were up at the same time. The longer-term trends certainly have tended to play out as you probably would assume, though. Looking at some other asset classes very quickly, and then let's look at some of the charts together and see what we can discover. 10-year yields actually finishing a little bit higher than they were on Friday, but the majority of the day was actually spent with yields coming down. And actually, the long bond actually came down quite a bit. It rallied in terms of price. The 30-year yield came off quite a bit. So overall, interest rates, I would say are in a position of strength. I think bonds are in a position of weakness. You can see that on the charts of the ag and the TLT, which we'll try to make a little a minute or two for here in a moment. But overall yields continuing higher. The dollar actually flat from Friday. Gold is a challenging chart, and I think the challenge on a chart like the GLD is not the price deterioration, because overall it's hanging in there okay in recent months. The challenge is the opportunity cost of owning precious metals and therefore not owning other things that are doing so well. So the relative strength is what's killing you owning something like gold right now. But we'll look at the chart here in a moment. The GLD finishing in a position of weakness, getting back below 165 here at the close. Cryptocurrency is quite choppy, although over the weekend, Bitcoin continued to hold up pretty well, pushing above 60,000 and for the most part, remaining there, currently just above 61,000. We talked about that 60,000 level, those big round numbers, 30,000, 40,000, 50,000, now 60,000 continue to be really meaningful for something like Bitcoin. That is not a surprise to me, and that's something that's actually fairly well documented. It seems like one of those silly things that a chart would revolve around big round numbers, but it actually is the case. And studies have been shown that orders actually group around big round numbers because that's how humans that are putting in those orders tend to think of things. Let's try to hit on some of the charts on each of these here in a few moments and see what big picture takeaways we can come up with. So here's a chart of the S&P 500. I was on a panel earlier today with a couple other market experts. We were talking about the market environment, and they were much more short-term oriented than I am, as you probably know from watching the show. My goal is to think about the short term, but really within the context of long-term trends and cycles. And I think the person that was on the interview referred to the recent, maybe last 4 weeks as a head and shoulders bottom. And I take a little bit of problem with that, because I think if you call anything a head and shoulders, I think it would have to be this distribution pattern. A classic head and shoulders top would be a rally, an extended rally, and then usually a couple months, a true head and shoulders pattern. If you go back and dig out your Edwards and McGee book, which I would encourage you to do if you haven't done it in a number of years, really look at what they talk about when they're talking about head and shoulders reversal patterns. It's really a multiple month sort of pattern. It has a big volume component, which we don't usually look at. So we're kind of cutting the corner a little bit when we call things head and shoulders patterns and not do all the due diligence of the specifics. However, I mean, I think the challenge with the market is it's not just whether or not you call it a head and shoulders, it's the fact that you broke down to a new swing low. And that's what really defines a head and shoulders top. If you have a low, and then you undercut it, right? You make a new swing low. And that for most disciplines is an indication that the trend has reversed. That's what we saw. And that's how we started the month of October. I remember doing my monthly chart review for my market misbehavior premium clients. And we were looking at that. And at the time we're breaking down. It's the first week in October. And I'm thinking, wow, this could be the beginning of a much deeper sort of pullback. However, the world's changed a little bit, right? And if you take a trend line, taking the head and the right shoulder, that's now been broken. That's one of the early indications a lot of times that the head and shoulders pattern is not really seeing the follow through you might expect. We're breaking back above the 50-day moving average. And again, while that may seem like an overly simplistic way of thinking of things, in general, sticking with things that are above their 50-day and not sticking with things that are below their 50-day tends to be a pretty decent way of staying in extended trends and making sure you manage your capital if you get out of it. I think one of the key things with the S&P chart, by the way, right now, as you look at this week and renewed strength and the prospect of renewed strength with all these additional stocks that are going to be reporting earnings this week, including some fairly big ticket items like Netflix and Tesla and others, is whether this market can sustain above the 50-day moving average. And I'm going to be looking at the RSI, which is here at the bottom. In a bull market phase, the RSI should be getting above 60 in a rally, and we're right there today. So I would love to see if you do see further strength this week, driven by some of the earnings wins I know a lot of people are calling for. The RSI getting above 60 would put it back in the realm of where we spent much of 2021, where the RSI becomes overbought on the big impulse moves higher. That's what would potentially propel you above 45.50, which I think would be the ultimate level you'd be wanting to look for. Just really quick, a chart or two, and then we need to get to look at sectors. The GLD. So when I'm asked about gold, I have to say overall, it's not just the fact that the chart is not positive, which I think is absolutely way to, at the very least, to describe the price action. It's been relatively weak since last August, to be honest with you. Although there have been moments where you've shown some renewed strength. overall, especially in the short term, you're making lower highs every time the market tries to go higher. So gold tries to eclipse previous highs and fails. Until that changes, the trend overall is more negative than positive. And a couple things I would want to see. Three things. If you go down the vertical axis of this chart, number one, I think most important, gold has to break out and make a new swing high. The GLD has attempted to get above 172 a number of times, has failed to do so. You'd want to see that follow through to the upside to confirm some sort of rotation higher. The second thing, the RSI, just like we talked with the S&P 500, with the RSI right at 60, the GLD has run into that resistance a number of times in July and August, in September, and now once again here earlier this month, last week in October. So every month you've attempted to get above RSI 60 and failed, and so that is more characteristic of a bear market phase. Beyond those two things that would certainly cause, I would guess, gold to outperform, you'd want to see the relative strength turn higher. Because I think the biggest challenge on the chart of gold for the last 2 years is that you just haven't been paid to own gold relative to the S&P. And so I would rather own things where that relative line is going higher, because that tells you at the very least you have a chance of outperforming a passive, SPY sort of holding, the VTI or something like that. So that is the big picture. I think that's where we're at. I think the S&P, the rally over the last week is impressive. The follow through and sustaining above the 50-day, the RSI improving, the momentum strengthening, I think are things that would convince me that there's more upside to be had. Compare that to something like gold, which is not breaking above previous resistance. Later, we're going to talk about individual names, how that fits into the overall picture. But our next segment today is called sector setup. So we've talked about the big picture. Let's look at the 11 S&P sectors, how they're rotating around the S&P in the middle. We're going to start with the RRG. My friend Julius DeKempener designed this visualization years ago. And before we had it on StockCharts, before I saw it proliferate, Julius was a publishing analyst on the sell side at a bank located in Europe. And I enjoyed getting his research, and we asked him to start sending us images of the RRG every week so we could make a big PDF or put the images in a stack and start putting the relative rotation graph in motion, because it was such a beautiful way of visualizing it. I'm thrilled that we all have the ability to do that, and it's by clicking on the chart in the upper right, little preview chart, and actually showing how these sectors are rotating around the S&P in the middle. Now, what you'll notice if you back up the rotation for a little bit and then put it back into play, as you can see the strength of energy. And energy has often, in 2021, been an extreme outlier. It's either been the best thing ever, according to the RRG graph, or the worst place ever, depending on where you take the snapshot. And it's really been pretty far extended. And when it's far away from that zero line, from the crosshairs in the middle, what that tells you is there's really more opportunity, both on the upside and on the downside. This is something that's either been the best place to be or the worst place to be. It's rarely been one of those kind of in the middle places, which is something like the XLC has been. Well, the XLC chart, communication services, has not been horrible for the most part. You really haven't gained anything on a relative basis owning the XLC. It's basically the market, right? The chart of the XLC and the chart of the S&P 500 look very, very similar for good reason. Charts like Facebook and Alphabet and others that are embedded in that XLC chart, of course. However, I'd much rather be looking for opportunities that give you a chance to outperform, which is what the RRG was really designed to do. Show you what is getting it done better than the indexes, and make sure that you allocate enough to those things. So the only one of the 11 S&P sectors that is in the leading quadrant currently, even with the renewed strength that we've seen in the last week or so, is the financial sector, XLF, followed closely behind by the XLY, the consumer discretionary sector, excuse me. It's interesting when we think about the XLF, and we'll try to look at a couple of banks here a little later in our next segment on individual stocks. But I think financials between now and year end in particular is a play on higher rates. If you think bonds are going to continue to go lower, if you buy into the idea of rates going higher, the XLF is most likely then going to continue higher. That's a huge tailwind for the performance of banks, charts like Key and others that have the potential to move onward and ever upward. So I would be looking for the XLF to continue that. I do think that's the situation we will be in for the foreseeable future. I do see rates going higher, and the charts certainly have been backing that up so far. And I would look for the XLF to continue to outperform. Consumer discretionary is an interesting one, and it's not just Amazon and Home Depot and Tesla. Those three stocks are almost half of the XLY because they're mega cap names, and the other stocks in the XLY are sort of dwarfed by those three big ones. But if you look at the equal weighted consumer discretionary ETF, the RCD, it's also doing just fine. And it shows you that it's not just those big names that are working. It's a lot of other names in the sector that on average are doing pretty well and better than the average stocks out there. Energy certainly showing renewed strength, and we saw DVN pop up. I saw that pop up on some of the new high screens. We've seen other names in the sector that have popped up as well. Again, I think financials and energy are both part of this thesis of what could be leading sort of the reopening trade, the infrastructure trade, if you will, the higher rates trade, if that's a thing, that everything I just said, if that is a thing, those are the sectors that certainly appear to be leading just fine as the market is going higher. What is actually rotating lower? It's technology, it's healthcare, and it's real estate. Now, granted, those are that's all based on weekly data, and that's where I usually look at the RRG because it's a good high-level overview of what's working and what's not. If we look at the candle glance page of the 11 S&P sectors, I think it relates a lot to what we're seeing. The three sectors that we identified were in the position of strength. Number one, financials, the only one of the 11 S&P sectors in the leading quadrant. That is one of the few that is making a new 52-week high in the last week. Second one, in terms of most improved, is energy, which is rotating in a big way in the improving quadrant, heading toward the leading quadrant. That also has been made a new 52-week high in the last week. The third of the S&P sectors making a new 52-week high in the last week, consumer discretionary. And let's go there next. So those three sectors making new highs. This is why the RRG is such a great, simple way of identifying strength, right? You could look at 11 charts and find the individual patterns, or you look at the RRG, you see the strength is emerging. The XLY making new highs. If you look at the ratio of the XLY versus the S&P 500, the relative strength is going in the right direction, particularly in the last 2 months. If you look at the XLY over the XLP, which we highlighted last week a number of times, also breaking out. So these sectors breaking out to new highs while the S&P is not. There's your leadership. Those are the stocks and the groups and the themes that are starting to work. When we come back from our break in our next segment, Shifting Stocks, we'll pick out some of the individual names on the move, not just in these sectors, also places like industrials that may be worth a second look. We'll take a quick commercial break. We'll be back with you in our next segment, Shifting Stocks. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close as we break down the charts we feel you need to be most aware of as you plan your own investment process. A couple of quick comments before we get to our next segment. First off, we love to get your questions, and not just questions, feedback on our shows, feedback on your hosts, feedback on the content we're sharing with you. We love to help you and point you in the right direction. And we are also here to answer questions on technical analysis, technical indicators, particular charts, tickers, ratios, ETFs, market history, market dynamics, whatever it is. We will do our best to point you in the right direction. Best way is via email. Send your questions to the Final Bar at StockCharts.com. We're also on Twitter at Final Bar SCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts channel. We'd love to hear your questions. We'll hope to answer one of yours live on the air on tomorrow's show on Tuesday. Also, go to StockChartsTV.com. You can use your email address, set up a free account. We have so much great content every trading day and sometimes even over the weekend, helping you understand the markets, illuminating market dynamics and technical analysis, and hopefully giving you some actionable ideas to help reconsider as you're thinking about your own process. Go to StockChartsTV.com to set up a free account and watch all of our content on demand, or on any of your mobile devices. Search on any of the app stores for StockCharts TV on demand. Let's continue on with today's next segment, Shifting Stocks. This completes our three-pronged approach to market analysis. And again, in a 30-minute show, I feel like it's a 30-minute sprint touching on some of these things. And I try to just illustrate and give you the nuggets that I can to help you make sense of things. I don't think this eliminates the need to do a deep analysis on your own. And I hope what we're able to do is encourage you to dig deeper and try to answer some of these questions using stock charts, using technical analysis, and hopefully make better decisions. Our third segment here is called Shifting Stocks. This is where we focus on individual names. I'm going to go through a bunch of different things. We'll start with the industrial sector. We talked about some of the sector leadership, particularly financials, energy, consumer discretionary, where you're certainly seeing the sectors. Those are the three sectors making new all-time highs in the last week. Those are the three strongest emerging trends, but they're not the only ones you're seeing strength. And I think it's worth noting, I was asked about the transports over the weekend earlier today. And I think the transportation group, again, there are a lot of things represented there, but undeniably moving to new swing highs here. Of course, I just said, let's do that. Let's go to the chart of the transports, actually. It might be a good way to start. We think about the industrial sector, I immediately think of the transports because this captures things like railroads and airlines and other things, many of which are included, obviously, in the industrial sector. The 15,000 level on the transport, the Dow Transport Index, is a key one. We just broke above there, and this is really through the end of last week, through last Friday into today. You're seeing a rotation above swing highs. If you believe in the upside potential for stocks, if you believe in a rally from here through year end and beyond, if you buy into the bullish thesis that things are just going to get better, and some of the improving economic data, particularly on the demand side from the consumer, that continues to play out. If you think that that's going to work, I would argue charts like this should most likely be going higher. And I think you're seeing the transportation index getting above 15,000, which is encouraging. Holding above there for the transports, I think, is pretty interesting. We'll come back to Generac, but I'm thinking about CSX, right? Some of the railroads, charts like this are actually testing their highs, not quite breaking out. So you're seeing some emerging trends. I would love to see stocks like this break out. When I'm looking at the list, or not the list, but I'm looking at the breadth indicator, the new highs and new lows. It's looking at stocks making new 52-week highs. I think the bull case should involve an expansion in new highs, right? More and more companies that are able to eclipse their previous highs. That should be charts like CSX that recognize that the improving conditions, recognizing the additional demand or whatever that is causing, or at the very least buying power that's pushing the stock to new highs, which means it has to get above 34 and it has to stay there. So these sort of basing patterns are super easy. They're fabulous because you have a clear level of resistance. Once you can get above there and follow through, that is a very encouraging sign. Also has a natural built-in stop, a trailing stop to that, right? As long as we remain above that breakout level of that base, we remain above 34 overall, that is a good breakout with potential further upside. So CSX is one particular name that I would be eyeing in the industrial sector. If I can type the ticker right, we will get Generac, GNRC. Is obviously what is it? Generators. I couldn't come up with the word generator. Generators that you may have outside your home, and I know we often need here in the Pacific Northwest, and we certainly need it in the Boston area, dealing with the nor'easters and the brutal Boston winters. We relied on stocks like this and their products very, very heavily. This is one making a new high today, up 4% today, a nice rally. This is on one of the top performers lists when I was looking at the S&P names. But again, it's sort of like CSX, right? And it's just breaking to new highs. Stocks like this breaking out, holding that breakout level, which means for GNRC, that's holding above 470. Stocks like this holding those breakout levels, I think, is key to the bullish thesis for stocks. If you buy into the S&P improving from here, if you buy into renewed strength in November and December, I would argue charts like this should basically be breaking out and holding those breakout levels. If you start to see failed breakouts, charts like Generac attempting to break out and not following through. We finished the week weaker, right? We finish through now and Friday. We don't follow through on this upside breakout, but it's more of a failed breakout that rolls lower. I think that would be a big area of concern. For something like Generac, it gets down to 400. Now, that's quite a haircut from where we're at now. And granted, that's a big cushion built into the chart. However, that's what the chart is telling you. As long as we hold 400 on a pullback 390 or so overall, that's still a decent move. But particularly holding the breakout level, I think would be a key first step to watch to see if this short-term strength that we're seeing in stocks actually has sustainable upside from here. I'll jump around a little bit, but I'm just jotted down a bunch of tickers as I was reviewing things over the weekend and into this morning. Different group, Plug Power is looking a lot at some of the renewable energy names, things like solar stocks, Enphase, ENPH, and Plug Power came up. This actually came up last week when we were doing our Chart Madness Revisited special. Plug Power was one of the 16 stocks that we had selected in our initial bracket back in March. This is the group of stocks that we had to pick bracket style, March Madness style, and follow over the next 6 to 7 months. And this is a name that's actually really interesting. It has been in a sideways pattern. This is one of the better places to be going into the beginning of 2021, arguably one of the worst places to be in the first half of the year, as it just came off of those all-time highs and just got absolutely crushed, went from 75 at the peak down to just below 20 here in mid-March. From there, it's stabilized, and now you're potentially starting to rotate higher. Nice gap higher last week, and now we are approaching resistance in the form of the 200-day moving average, resistance in the form of the June highs. Getting above 35 would be an interesting upside follow-through to look for. It's up nicely today, up over 4%, but I would love to see it get above those previous highs. Now, when you're also talking about stocks breaking out, I'm not struggling to find names that are breaking out to new highs in the financial sector, in the consumer sector. And those are some of the groups that we talked about earlier in our segment on sector setups. Home Depot is a really interesting name. This is what sort of looks like a cup and handle like pattern where you have this rounded bottom. You have a resistance level around 340, a secondary test, a pullback to the 50-day, and then breaking above 340. 340 should be the line in the sand, right? As long as we hold that breakout level, that's a good breakout and still holding up, and it's continued to follow through over the next couple of days, but making sure that that holds up and continues higher is important. But overall, this is the type of chart that I would most likely assume is going to go higher given the strength and the fact that investors decided it was worth about this amount for about a 6-month period, and then buyers decided it was worth a little bit more. It's always an interesting chart to look for, an interesting breakout. So does Home Depot hold that 340 level? That would be a key thing to look for here. That's our segment, shifting stocks. Again, so many individual names we could look at, but those are some of the ones that bubbled up in my own work in the last day or two as I'm trying to make sense of the individual equities that are out there. We need to wrap today's show and go to the 3 in 3. 3 charts in 3 minutes. Here we go. We talked in our macro segment about the transports. Actually, we touched on it in the sector setup segments. We were talking about industrials and some of the renewed strength there. And I think the chart of transports is a really interesting one to look at. You know, traditional Dow theories looks at the Dow industrials and the Dow transports. It's a fairly antiquated way of thinking about the economic conditions, which is totally granted. You know, Charles Dow over 100 years ago, that was the economy, industrials and railroads. That was it. Now, of course, I would argue the new Dow theory using the S&P and the NASDAQ is probably a better way of understanding the broader economic conditions, looking at the old economy and the new economy. However, I'm always intrigued when transports are doing well. Things don't ever seem to be that bad when transports are going up. And I think that's what I'm facing right now. When you think about the market conditions, when you're trying to come up with reasons to be bearish, transports breaking out are certainly not one of those items that would make you feel more confident about a bearish thesis. I think charts like this breaking out are what tell me to not be too negative and to think more about the bigger picture, which is the overall strength in stocks, particularly now through year end as we go into the seasonally stronger part of the year. When I look at the S&P 500, we look at the daily chart pretty much every show, so I don't want to belabor that, but I just created a little different chart to share with you in this segment here. We have the S&P's daily price bars at the top with the 50 and 200-day moving averages. Worth noting, by the way, the last 2 days, Friday and today, closing at the highs. Always more of a bullish tell when you have the market rallying into the close, of course. But if you look at the RSI, there's 2 things we're going to look at, the RSI and the new highs. With the RSI, I have this green shaded area that shows you for much of 2021, you had the market going higher, and on pullbacks, the RSI would hold above 40. That is really classic for a bull market phase where the RSI never really gets below 40. That all changed in September, which is why you probably heard my tone turn a lot more cautious. All of a sudden, the RSI is getting below 40, which is more characteristic of a bear market phase. Right now, we're potentially starting to alleviate that and get back into the bull market area. In a bear market phase, the RSI should peak around 60. We're kind of right there. So if this really is a bear market, a corrective pattern with more downside to be had, the S&P should fail right about here. The RSI should fail to get above 60 with any significance and should rotate lower, which is why I think this week is crucial with all these stocks reporting earnings, the potential to move the market higher or lower. Also, I would look at the expanding number of new highs. One of the more bullish features of the market over the last month has been the expanding new highs list. This market going higher from here and the S&P getting above 4550 would rely on more and more stocks making new highs. Finally, the chart of gold. Again, if I'm looking for bearish charts out there, 2 things that jump off the page or immediately I'm drawn to are bonds and gold. And they're just not showing enough strength relative to stocks, which continue to be the place to be on a relative basis. Cryptocurrencies aside, that's a separate argument. when I'm looking at the chart of the GLD, I'm seeing the RSI hit resistance around 60. Now, I would be interested to see if we can get above that and if the GLD can get above 172. Folks, that is our show for today. Thanks so much for joining us every weekday after the close for the Final Bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.